Welcome to Section 4 of PNJ Group's ASC 710 training. Deferred compensation is one of the most misunderstood areas on the balance sheet, particularly when rabbi trusts are involved. This section covers how to accrue the obligation, how rabbi trusts work, and why you cannot offset the assets against the liability even when both relate to the same plan. By the end of this section, you will understand what deferred compensation is and exactly when to record the obligation. You will be able to explain why rabbi trust assets do not leave the employer's balance sheet, even though the whole point of the trust is to set money aside for employees. You will apply the gross presentation rule that prohibits netting the asset against the liability, and you will work through the journal entries for all three stages: accrual, funding the trust, and eventual payout. Deferred compensation arrangements are agreements where an employee gives up the right to receive current pay now in exchange for a promise to be paid at a later date, usually retirement, but sometimes death or disability. From the employer's perspective, the obligation builds up over the service period during which the employee earns the right to the future payment. Under a ASC 710, that obligation is recognized progressively as the employee renders the services that give rise to the benefit, not all at once when the arrangement is signed, and not when the cash finally goes out. To provide employees with some confidence that the deferred compensation will actually be paid, many employers set up a rabbi trust. They deposit assets into the trust, typically investments, that are earmarked for the deferred compensation program. The employee has an informal assurance that the money is sitting there. Here is the catch that drives all the accounting. Those assets are still accessible to the employer's creditors. If the employer goes bankrupt, the creditors can reach into the rabbi trust. That one fact changes everything about how the trust appears on the balance sheet. Because the rabbi trust assets are reachable by creditors, they are not considered held exclusively for employees. They stay on the employer's balance sheet as assets, typically measured at fair value if invested in securities. The deferred compensation obligation also stays on the balance sheet as a liability, and here is where mistakes happen. You cannot net these against each other. There is no right of offset. Both the asset and the liability must appear separately gross. Teams sometimes present only the net liability, reasoning that the assets exist to fund the liability anyway. That reasoning is wrong under U.S. GAAP, and auditors will push back on it. There are two distinct accounting events to understand. The first is the annual accrual, debit deferred compensation expense, credit deferred compensation liability. This entry recognizes the obligation as the employee earns the right to the future payment through service. It has nothing to do with cash moving. The second event is funding the rabbi trust, debit rabbi trust assets or investments, credit cash. This entry reflects the employer moving cash into the trust, but notice the asset stays on the employer's balance sheet. The cash transformed into an investment asset, but the total assets did not change, and no liability was reduced by this transaction. Two separate, independent entries. When the employee eventually retires and the deferred compensation is paid out, the liability is settled. Debit the deferred compensation liability, credit cash. If the employer liquidates the rabbi trust to fund the payment, a separate entry removes the trust assets and restores cash first. Debit cash, credit rabbi trust investments. Then that cash pays the employee. If the liability was fully accrued over the service period, the payout has no profit and loss impact. The expense was already recognized. The whole system works the way it was designed. Expense in the periods of service, cash out at retirement. On the balance sheet, the rabbi trust appears as a non-current asset, labeled clearly as rabbi trust investments or similar. The deferred compensation obligation appears as a non-current liability. Both are visible separately, and neither is offset against the other. If the trust holds securities, they are remeasured to fair value at each reporting date. Changes in fair value flow through the income statement or other appropriate line depending on the classification of the investments. The bottom line: this arrangement creates balance sheet gross-up that teams sometimes want to minimize, but the standard does not permit it. Deferred compensation follows the same matching principle as everything else under a ASC 710, expense when earned, not when paid. The rabbi trust is a funding vehicle, not an escape from the balance sheet. Both the assets and the liability remain visible, separately, with no offset permitted. Funding the trust moves cash to an investment asset. It does not touch the liability. And when the employee is finally paid at retirement, the previously accrued liability is settled with no new expense. Next section covers the journal entries for all compensation scenarios. Let us make sure every entry is in the right place. Thank you for completing this section on deferred compensation arrangements. Thank you for watching. Subscribe for more training from PNJ Group.